Good morning and good afternoon to everyone, and welcome all of you who are joining us online for the second day of the Gold Forum Europe 2022. My name is Tim Wood, Executive Director of Denver Gold Group, and truly a warm welcome. Glad to have you joining us today. And it's a pleasure to introduce today's keynote speaker, Alasdair Macleod. Alasdair is well known for his career as a stockbroker and member of the London Stock Exchange for over 4 decades. His experience encompasses equity and bond markets, fund management, corporate finance, and investment strategy. I can assure you there's a lot more detail than that, but we had to compress it for time purposes. But please do go on to goldmoney.com and you can learn more about Alasdair's detailed biography there. And Alasdair, in fact, joined Goldmoney in 2011 as head of research. And since then, he has written a really informative and essential weekly column on economics, finance, precious metals, and geopolitics. And because of that, he's a frequent guest on podcasts, radio, TV, and as a conference speaker. And for those of you who don't know, which is probably a very small audience, Goldmoney is a convenient way to purchase physical gold, silver, platinum, and palladium bullion online. The company has assets under management, in a sense, safeguarding $3 billion worth of those assets for clients in over 120 countries. Alasdair, thank you so much for taking the time to give us today's presentation, and look forward to hearing from you, and then we'll catch up with some Q&A at the end of your formal presentation. Over to you.
Thank you very much indeed, Tim. I think what I'd like to do is I'd like to start with something, just because really what we need to know is what we're dealing with. What is money? Now, I've got here a £20 note, which has got in very small print, and I have to say the print is getting smaller and smaller every time they reissue new issues of banknotes. I promised to pay the bearer on demand the sum of, in this case, £20. Now, £20 was originally, it was £20 of silver, but from just after the last of the Napoleonic Wars, it became gold because we went on to a gold standard. Sterling went on to a gold standard. So that was £20. Now, a pound in gold was one sovereign coin. So this says that it entitles you to 20 sovereign coins. Now, you go along to the Bank of England, they won't let you exchange that for any gold at all because, you know, gold standard is all history. But to give you an idea as to what's happened to this as opposed to gold, the sovereign today is worth about £380. So in other words, you need 19 of these to just go and buy one sovereign. And that's what's happened to this paper stuff compared with gold. So that, if you like, is a sort of introduction to where we are. Now, I need to define money a little more accurately than that. The legal definition of money is gold and silver coin or bullion. And that actually hasn't changed from Roman law, which really set out, it formalized, if you like, what we already knew from the point of view of mercantile trade. And British law, or more accurately, English and Welsh law, English law, if you like, really continued that tradition through in the 19th century. And indeed, it's still the case today. If you have a sovereign, it's not subject to any taxes or anything like that. There's no capital gains tax or anything. It is actually still legally money. That is the point. Now, money actually does have, and in this, I'm going to also include currency, which is the liability of the central bank, which is what that is, and also bank deposits, which can be drawn upon by taking money out of the bank or alternatively transferring money from one deposit account to someone else's deposit account, either electronically or by check. But all those forms of money and currency do have a special legal status in criminal law as well. And this is a very, very important point. If you, let's say, if someone steals your money and that person then passes it on to someone else who is not aware that it has been stolen and is not a party to the theft in any way, then you can't recover that money. I mean, that's the end of it. Now, this is very different from any other form of property. If you, say, have an old master or something like that, and someone steals it, and it's fenced and it's passed through, and someone, and eventually someone ends up with it, and you manage to identify, hey, that's my painting, that is still your property. And there's no compensation required to pay to the person who thinks he owns it. Now, this is desperately important because a lot of people today think that cryptocurrencies are going to replace currency. Money is going to be the new form of money. This cannot be the case because under property law, it does not have the exemption that money and currency has if it is stolen. So in other words, if, let us say, you buy some Bitcoin and it is established that somewhere down the line, down the blockchain, someone stole that Bitcoin, then it's not your Bitcoin. You haven't got it. You don't have title to it. So, I mean, I want to make this point absolutely clear that despite all the changes that we have seen, the evolution of money, the evolution of credit, the evolution of technology, one thing has not changed, and that is the legal status of money, and particularly gold and silver. And this is really the basis in which we have to proceed to look at our current condition and the potential failure of our fiat currency system. And I should add that every fiat currency system eventually fails. I mean, except this one, which is still current, still running. But basically, they have all failed throughout history, and there is no reason to suspect that this one won't fail. And I think recent developments have made this failure a lot more obvious to us. And so the purpose of this talk is to try and explain to you how I see this happening and why I think suddenly it has become a far greater danger. So if I just move on to the next slide, we can see, if we go back to 1971, it was then that President Nixon temporarily suspended the Bretton Woods Agreement. And the Bretton Woods Agreement basically said that none of us had any right at all to exchange paper money, paper currency for gold, except the central banks and certain supranational organizations like the IMF, for example. And that really ran from 1944, when the agreement was struck, until 1971, when the principal actor in this decided that they were no longer prepared to stand by and accept requests from other central banks to exchange dollars for gold. That was a very important point, because at that stage, I mean, there had been quite an increase in the amount of currency and credit in circulation from 1945 through to 1971, a significant increase. But since then, of course, the restraints have been lifted from the production of paper currency. And because it went completely fiat, there was no requirement, if you like, to promise to pay the bearer. And if you look at this chart, you'll see that the increase in broad money in America has increased roughly 32 times since then. Now, that is a very, very substantial increase, I think you'll agree. And particularly notable was in 2020, and in fact, the timing of that was actually March, second half of March 2020. The Fed basically went all in on producing currency and expanding its balance sheet in the sense of bank reserves, which is like a bank's deposit account at the Fed. And it reduced its interest rate to zero, and it started doing quantitative easing at the rate of 120 billion a month, which was like injecting raw money into the economy. So you can see how suddenly that accelerated up, and that's where we are today. And obviously, if you increase the quantity of money in an economy, and the economy itself is not keeping pace with the increase in the quantity of money, then you're going to debase that currency. I mean, I don't think that's a very controversial statement. where it perhaps becomes a bit more interesting is that the central banks have spent their lives trying to persuade us that money doesn't matter. I mean, I looked at the FOMC minutes, I think one before last, to see whether there was any mention of money in it. None at all. They were all talking about, price of this, price of that, and, where they thought the CPI was going and transition and all this sort of stuff, but no mention of money at all. In other words, the system has moved us away from understanding what this chart actually means. And that, I think, is very confusing for a lot of people who, for the last 50 years, have lost the sheet anchor of gold. That is now no longer with us. Now, this next chart, which I pinched from James Turk's new book, which was published the other day, Money and Liberty, that's it. This illustrates the point in another way. And it illustrates a point which is relevant to where I'm going with this. You can see that there are a number of lines here. The one that runs along the bottom is the gold price. That is, rather, it is the price of oil in gold grams. And you can see that from 1950 to today, the price has been very stable, measured in gold. And to put a little more gloss on that, I mean, this was indexed back at 100 in 1950 by James Turk. And today he tells me that the current price of oil measured in gold grams is 30% less than it was in 1950. Now, that's interesting because if you look at what's happened measured in pounds, in dollars, and in euros, and before the euro is the Deutschmark, you can see that there's huge volatility in these prices. I mean, currencies are meant to be stable, for goodness sake. They certainly have not been stable. And not only that, but these currencies have lost purchasing power measured in barrels of oil hugely. I mean, it has really been catastrophic. So the lesson from this is that if you talk about money, and by money I mean gold, and you price things in gold, then you have got a more or less constant price through all life's ups and downs. I'm not saying that the price is constant, but I'm saying it is more or less constant, certainly relative to these debauched currencies. So if we move on now, when we go back to the 19th century, there were periods of rising inflation, and you can see that the line that goes up and down like that is basically the inflation rate. And what drove the inflation rate? Well, it was the expansion of bank credit, because bank credit was by far the largest component of circulating media, currency and money, if you like, in the economy. Something like between 8 and 10 times the amount of central bank liability in the form of currency notes, in the form of these. So the fluctuations in bank credit actually had an enormous effect on prices in the economy, which is, what this inflation rate represents. And there is a cycle of behavior which needs a bit of explaining. What a bank does is it creates credit out of thin air. And it's actually a very simple process, but very, very few people understand it. If you go into your bank manager and you say, I want to borrow some money, and the bank manager thinks you're a good risk, and he says, okay, fine, I will lend you the money, sign here, you sign the document. What the bank then does is it records the loan as an asset, as the bank's asset, because you owe it money. But you've got double entry bookkeeping. So at the same time, the bank records your checking account, your deposit account, your current account, whatever you like to call it, with the proceeds of the loan. That way, you've got an asset balanced by a liability. Simple accounting. And you find as you go out the door, the bank manager shakes your hand, as long as he hasn't got COVID, and he says, the money is now in your account, you're free to draw it down. And that is indeed the situation. Now, what's happened is that the bank has created a loan as if by magic out of thin air. No one else is involved. No other depositors. They haven't had to go and sort of hunt for depositors for deposit to cover the loan that they're going to give you. No other bank involved. It's not. They're not waiting for you to spend it all the way around. Other bank accounts and all the rest of it coming back to the bank and so on. No, it's created out of thin air. Now, the bank hasn't used its own capital at all, which is another point which is worth understanding. What happens is that the bank has a certain amount of money and it lends a considerably larger amount of money into existence, so that you get a relationship between the total assets and the equity in the bank, the capital in the bank, whereby, perhaps there's somewhere like 5, 6 or 7 times as much lending going on, in other words, assets in the bank, as there is actually of the bank's own capital. So the bank is effectively a dealer in credit. It's nothing else than that. Basically, it will create a loan to lend at one rate, and it will, deposits on the other side where it has to pay it out, it will pay it out at a lower rate. And that applies, let us say, if you walk in and say, I want to deposit some money, the bank will say, thank you very much indeed. We're very happy to take that deposit, and we will pay you a rate 3% or whatever it might be. So they are dealers in credit. And I think this is important to understand. You can see now why it is that if, let us say, a banker gets optimistic about economic conditions, then he's going to extend his balance sheet relative to his capital more than he would under any other circumstance. And the creation of this credit by a cohort of bankers obviously sends a signal into the economy. We all sort of see that suddenly there seems to be things that are looking up, they're looking good. Why? Because of all the credit. I mean, we don't understand that it's credit at the street level, as it were, but we do understand that economic conditions have improved. And inevitably what happens is that there is a greater demand for the available resources in the economy as a result of that extra credit coming into the economy. And that drives up prices. So we have a situation where our inflation rate in this chart starts rising. And it gets to the point where our business calculations, if we're manufacturing something or retailing something or importing something, our calculations start going askew because our costs are rising faster than we thought they would, and so on and so forth. And our banks pick up on it very, very quickly. And they understand that the conditions, because of rising prices and so on and so forth, the conditions aren't as good as they were when they started expanding the quantity of loans on their loan book. Now, bear in mind that at this stage, you probably find the relationship between assets and the bank's equity is 10, 12 times or something like that. And then suddenly, the banker has moved from being greedy for profit to being fearful of losses. And that explains why the credit gets withdrawn and the prices start falling. So this is a regular cycle, and it wasn't actually properly understood for some considerable time. But having said that, we went through World War I. We stopped, if you like, any gold convertibility at that stage, as did everybody else. After the Second World War, we were then looking at a very, very different economic and social environment. I emphasize the link between economic and social because that was the thing that really drove it, rather than sound money considerations. Trade unions in the tail end of the last century had begun to increase their power, their influence. You had, sort of growing intellectual Marxism and all this sort of stuff. The socialist bandwagon was really beginning to roll. And of course, politicians, they couldn't really stand in the way of this too much. But the last real recession or slump, which governments didn't get involved with, didn't try and stop, was in America in 1920 to 21. And it was very, very brief. It was something like 18 months. The government at that time did what governments previously had done. They just stood back and said, look, we're not in the business of the economy, tough and all the rest of it, but we're not going to get involved because we will probably screw it up. And that was, a pretty sensible attitude. And out of that, we had a very, very rapid recovery. It just sorted itself out. So that was fine. But then we had the Federal Reserve Board, which had been constituted just before the First World War, was then really sort of beginning to develop its muscles, as it were, because it was representing at that stage the majority of the banking system. And as such, it had an awful lot of monetary and economic power. And the first governor, Benjamin Strong, deployed this. And he deployed it very, very clearly, expanding the quantity of money in circulation in America. And the result was that you had the Roaring Twenties. It was a sea of credit. And we also saw the bubble aspect of it, particularly in sort of 1928 and in early 1929. And you got the legendary bellhops giving people tips in the lifts and all the rest of it. So that was the first major financial bubble, as it were. The effect of that was, the Depression was horrendous. It really was. But the reason that it continued was because the politicians interfered. It was going to happen because of the bubble. And Benjamin Strong, in charge of the Fed, was very, very culpable when it came to fueling this enormous bubble. And obviously, you have a bubble, it bursts. And that's basically what happened. But you had, first of all, Hoover, and then you had Roosevelt following him, interfering in the economy, trying to make things better. And basically, the Depression continued until certainly into the Second World War. And by 1940, I think I'm right in saying that unemployment in America was still running at about 15%. So this did not work. The whole of the capitalist world, if I can call it that, in very loose terms, said never again, never again. We cannot permit this to happen. And it's really out of that governments have progressively taken control or tried to take control of economic events. Now, I come back to the end of the Bretton Woods Agreement. This was very, very important because that set off a new fiat currency system. And if we look at what's happened to their purchasing power since 1971, this actually goes back to 1970, you can see that, the dollar has lost, and this is a log scale, by the way, the dollar has lost over 98%, or just on 98% of its purchasing power over the last 51 years. Sterling has lost 99%. You've got the euro, and the mark before it has lost somewhere between the dollar and sterling. And even the Japanese yen has lost over 95%. And I've got more to say about the Japanese yen a little bit later. So you can see that the events, the abandonment of Bretton Woods was a very, very serious situation. It has actually led to the virtual collapse in the purchasing power of currencies. Now, I'm from here. I want to put the fiat currency story into phases. I've described the up to the Bretton Woods Agreement. We've had a brief look at what's happened to currencies since then. But let's just home in on that a little bit, because in 1973, President Nixon and Kissinger went along and saw the Saudis and came to an agreement with them. They said, look, we can't stop you pricing the price of oil at anything you want. But one thing we will insist is that you take payment in dollars. And that was agreed upon, and that was the birth of the petrodollar. And the dollar then lost its purchasing power substantially in terms of oil. If I can refer back to James Turk's chart of the oil price in dollars, compared with gold, you saw exactly what happened since then. The effect of it was really, and it was almost a sort of byproduct, I think, in a sense. Everything became financialized. Now, what I mean by that is that in the mid-80s. I mean, we had the inflationary 70s, which was a nasty experience and all the rest of it. But when things settled down in the very early 80s, the banking industry moved towards fee-driven income. And this basically meant that instead of doing, the creation of credit, as I described earlier, they had their hands out for fees for investment management, running regulated futures exchanges and things like that. I mean, so in other words, they started moving away from financing production, goods and services, into purely financial activities. And this has increased. I mean, you had the start of the hedge funds, and you had the blow up of the long-term capital management back in, I think that was 97. And after that, you had the dot-com bubble, and then following that, in the early noughties, we had the development of over-the-counter derivatives, and that grew into a quadrillion dollar market. I mean, just incredible. And of course, with declining interest rates from that peak way back in 1980, when the Fed funds rate went up to 19.5% to down to zero recently, the effect of that was to increase the value of financial assets. I mean, okay, there were ups and downs and so on and so forth, but you had this general increase in financial asset values. And so financial assets became more and more attractive as collateral for the banks when it came to printing credit. So that's what I mean by the financialization of the global economy. Basically, dollars, euros, yen, pounds, all these currencies experience the same thing. And certainly in terms of production at the same time, I mean, this is particularly noticeable for America, an awful lot of production of consumer goods and things like that migrated to places like China and Southeast Asia. So, really, the banks in America, the banks in Europe and the banks in Japan were increasingly, they were sort of losing this connection, if you like, with production, with financing, expanding credit for the financing of production. What they were doing more and more and more was financing purely financial activities and securing it with purely financial assets. So now we come to a situation where we have a real problem, because suddenly we find that Russia walks into the Ukraine. And what do? We say, shock horror, this is terrible. We have to sanction Russia. And not only do we sanction Russia, but we make sure that she does not have access to our wonderful currencies to pay for commodities, oil, oligarchs, bringing in their luxury goods into Moscow, whatever. This is a disaster, an absolute disaster, because what has happened is that instead of penalizing the Russians, we've ended up penalizing ourselves. Let me explain that a little bit more. I'm sure everybody listening to this is aware that the Europeans have been closing down their fossil fuel production, and the Germans have even been closing down their nuclear production. And they have refused to reopen their nuclear production, or to stop it being run off. What they've been doing basically is they've been saying, we're good people, we do not create global warming, but we will buy our energy from someone else who isn't subject to the same restrictions. So guess what? Germany has 40% of her natural gas, or her energy, comes from Russia. And the situation is not that different for Italy, Austria, and various other really key economies within the Eurozone. What Russia has done is very interesting, and it does affect our currencies. What she has said, and it's principally to the EU, who is her major customer in this respect, she said, we're quite happy to sell you natural gas and oil, but we insist on being paid in rubles. And we will, we can come to an agreement over a sensible price. But if you don't want to pay in rubles, then go fish. So in other words, go out, Go into the market and see if you can replace it. And of course, there is absolutely no way in which this can be replaced. And what this has done is it's created a very interesting situation. I mean, interesting as a monetary historian. I mean, it's not much fun for anybody involved, which is all of us. And that is effectively what Russia has done is it's tied the ruble to its commodities. Now, if I can just backtrack a little bit, this is exactly what China did when the Fed reduced interest rates down to zero and started doing QE of 120 billion a month back in, March 2020. China, literally the month after that, started accumulating commodities, foods. I mean, she now, for 20% of the world's population, which is roughly China's population out of the proportion of the total, she has got the majority of maize, rice, wheat, and I mean, it's sort of 1/3 of the global soybean stocks. I mean, basically, she's cornered the grain market. And then what happens is that Russia takes on Ukraine and removes the breadbasket of Europe from the equation. And it's not just the breadbasket of Europe, it's also the surrounding Russian area of the steppes, which is grain growing for exports. So we're going to have a major food crisis this year. And it's not just that. They're also major exporters of fertilizers. And so anyone trying to, keep their crop yields up is going to have a problem because the cost of doing so is going to make it uneconomic. So we do have a major problem here. But coming back to the Russian story, rather like China, which is effectively what China has done, China understood the inflationary implications of Fed policy. So it said, no, we want to be separate from that. We want to insure ourselves against that. They have effectively commoditized or linked their currency to commodities. And that is precisely what Russia is doing as well. So we have a situation. What's going to happen? How does this affect us? Well, it's quite simple, really, because we have seen prices rising. We have seen central banks turning around and saying, well, it's a transient problem, and then saying, well, it's a bit more sticky than we thought. And I think the latest I heard, they're saying, well, it might not quite come back to 2%, but, we would settle for it drifting back to 4%. This is rubbish. I mean, we've already seen ahead of the sanctions against Russia and the effects on global commodity prices, we have already seen rates of price inflation measured by CPI exceeding 8-9%. And if you look at PPI, the Producer Prices Index, it's a lot more than that, a whole load more than that. So we have bond yields, which currently are reflecting very, very low interest rates. Yet we have inflation, which is admitted by public statistics, which understate the situation usually. I can say that without any fear of contradiction, considerably higher. So everything is on hugely negative interest rates. So don't expect the rise in interest rates to stop at 3%, 4%. 5%. It is actually, with what's happened with Russia, quite credible to forecast a rate, let's say a yield on a 10-year bond approaching 10% or even more. And I'm not just talking about, rubbish currencies. I'm talking about dollar. I'm talking about euros. I'm also talking about yen. I'm talking about sterling. This is a major interest rate crisis. What does this mean for financial assets upon which we have based ourselves for the last 50 years, increasingly so over the last 50 years? Well, the answer basically is that the bubble, which has developed as interest rates fell from 19.5% down to zero, and in the case of the euro into negative rates, in the case of the yen into negative rates, that means that we're facing a real collapse of these financial asset values. And the effect on government finances is not worth thinking about. I mean, it's just catastrophic. What are they going to do? I mean, it's quite clear that what they're likely to do is to try and resist this temptation. I mean, we've already seen this by their being in denial about actually what's going on with prices. And remember, I said that in the FOMC minutes, there's no mention of money at all. They've lost the plot completely. And so we can see that there is going to be a major bubble pop. And the pop is going to be financial assets. What do? Well, the answer basically is that the mandate is to try and keep the economy going, keep unemployment from rising. They want to keep the whole show on the road. And that basically means that the one thing that gets sacrificed in all this is the currency. Now, here I've got a chart of the euro against the US dollar, and you can see that since about middle of last year, there's been a very defined downtrend in the euro's value. The ECB has a problem because it has a great amount of government bonds on its balance sheet. And as the yields rise, their values fall. And it's got to the point where, by my calculations, the ECB has basically wiped out its equity. The liabilities now exceed its assets, which means it's got no equity in the balance sheet. So who are its shareholders who it can turn to for recapitalization? Well, they're the national central banks. Guess what? The national central banks are in exactly the same position. They all, almost without exception, have liabilities exceeding their assets. And then if you look at the banking system, the commercial banking system underneath, remember I was talking about the relationship between assets and equity. Well, that's something else. Assets and equity, in the case of the major banks in the Eurozone, is well over 20 times. So you can see that the whole of that system is in difficulty. Now let's move on and have a look at the yen. Now, if that is a collapse if ever I saw one. Now, this is, I mean, the Bank of Japan is in exactly the same position as the ECB. Negative interest rates. It's been doing QE since the year 2000, which is an awful long time and has meant that it's got a huge level of bonds and all the rest of it on its balance sheet. So the values are collapsing. What it's done is it's turned around and it said, we can't take this anymore. We are going to buy the 10-year JGB, which is a Japanese government bond, at a yield of 0.25% for as long as it takes. In other words, they're drawing a line in the sand. We're going to protect our portfolio, but it means to hell with the currency. And that's what's happening. So the order of events, it seems to me, is the market is telling us that the yen is collapsing first. I think that the euro will be very, very quick to follow. And of course, if you have a banking system which in America, which is interlinked with, around the world, having been, the world's reserve currency, I mean, the exposure all around the world is absolutely enormous. And the American banking system, which is not nearly as highly geared as the Japanese or indeed as the ECB's charges, as it were, the commercial banks in the euro system, not nearly as highly geared. That's not going to save it. So we come back to, what will the Fed do? My bet is that the Fed will try and protect the domestic economy in preference to the currency. Now, this means that you don't look at the foreign exchanges for, strong currencies, weak currencies, whatever. You've got to look at what they're doing in terms of commodity prices, and particularly as representative of commodity prices, gold. And that brings me on, I think, pretty much to the last slide I have. No, well, that's the yield. That's the US Treasury yield. Now, that's just started. That's going to be running up, in my view, towards 10% and possibly further. So if we come back to James Turk's chart, how do you protect yourself from this? I mean, I don't think anyone here is seriously thinking that you're going to rush out and buy rubles or buy Chinese renminbi. For a start, they're not available to us other than maybe as tourists, if we were ever in that position. No, the only way you can do it is to buy what they have tied themselves to, which is commodities. And the best representative of those commodities is something which we have all forgotten, and that is real money. Gold, silver also. That still qualifies, and that's not being priced as money yet. So there's a bit of a catch up there, perhaps. But gold is the message that I get from this switch, this collapse of the financial currencies, which have been getting themselves increasingly tied into lower interest rates for the last 50 years. That is now changing. The thing to do is to get out of that as much as you can and follow the Russians, follow the Chinese, buy some gold. Thank you very much.
Thank you, Alasdair. Absolutely fascinating. And continuing on from your concluding comment, we have a question that someone posted online asking if you expect China to diversify its $3 trillion plus in FX reserves away from the USD to gold, and I would guess other commodities in that basket as well.
Tim, I think certainly they've been doing it as far as commodities are concerned. That is for sure. The other thing that she's been doing is she's been lending dollars to other countries. So in a sense, she's got them off her book, as it were, immediately. But there's no doubt about it that she will lose quite a lot of money through the demise of the dollar. And, this is not good for China. I mean, don't get me wrong, because she's still very, very much tied in with her trade surpluses are with us in the West, in essence. So she's still going to be earning dollars, euros, yen, and pounds and Swissy and so on. So this is not necessarily good for China, but what I'm trying to point out is that she has protected herself. As with respect to gold, she has effectively cornered the world gold market, physical gold market, because she set up the Shanghai Gold Exchange. It's now by far the largest physical exchange in the world. Even in London, through the Hong Kong Stock Exchange, she owns, if I can say that, she owns the LME. And not only that, but one of the big Chinese banks is a very active player in the new gold contracts on the LME. So this is something which China has been doing. Now, I reckon that before she set up the Shanghai Gold Exchange, she actually was in the market accumulating gold, not telling us about it. Of course, nobody tells you that they're accumulating gold. And I calculated that on the basis of flows, first of all, capital flows into China in the early 80s and into the early 90s, and then growing export surpluses after that. I think that before 2002, she could have easily accumulated 20,000 tons of gold. Now, that's as the state. She then turns around and says to her people, you know what? We've removed the ban on you owning gold. You can now rush out and buy gold. And furthermore, they were advertising in the media and television, go out and buy gold. And the result is that withdrawals from the Shanghai Gold Exchange since then have been over 20,000 tons into public hands. China also invested hugely in gold mining. She became the largest gold miner by a country mile for some time. I mean, the yields have dropped recently a bit. On top of that, silver as well. She's had a very close control over silver. When it comes to refining, that is a public monopoly still. She controls gold. I mean, really does. And she has enormous interests in the whole thing. So my idea that the reason that they brought in the regulations in 1983, there's English translation, you can read it online, is quite clear. And that is that she wanted to protect herself against something which the Marxist economists were saying, and that is capitalism destroys itself. Capitalism destroys itself, right? What happens to the currencies? They get destroyed as well. So, in other words, I think right from the out, from virtually the death of Mao Zedong, China knew that if she was going to integrate with the West, she would have to buy gold. So, I mean, to answer your question or your participant's question, I don't think there's a physical goal there for China to rush out and spend $3 trillion in it. I think, in a sense, that some of that is lost. Some of it's been lent out elsewhere. I heard someone told me that she'd actually hedged it, but whether that's true or not, I honestly don't know. So I think China is going to go to bed with a lot of cost on the demise of our currencies. But that's not the point I'm making. The point I'm really trying to make is that she's realized that she's got to protect herself from a disintegrating currency system within the West.
And I think the point you made about the LME, you're reading between the lines, is that China was able to get the LME to buckle on that absolute debacle with the nickel trading, and what should have been a big win for the traders in London ended up being a big win for the Chinese market.
Tim, I couldn't possibly comment.
So do you think the opportunity or the possibility of a redenomination of commodities from the dollar to the renminbi, is that just a progression over time, or do you think that could be a shock event?
Well, I think it's a shock event because what I see is a sudden realization at some stage that our world of everything finance actually is falling down around our ears, and interest rates are going far higher. I mean, what are interest rates? Interest rates are not actually the means by which a central bank can try and manage an economy. No, interest rates are compensation for you as a lender and what you expect to get at the end of your, when you get your money back. So if you lend someone dollars for a year and you see that its purchasing power is going down 9-10%, are you going to be happy with just 2.7% or something like that on a 5-10 year bond? I mean, the answer is no. It's completely wrong, and that is a reality that we've got to return to, and it means that the financial bubble is going to pop completely. I think that the commodity relationship will be reflected in terms of pure purchasing power, loss of purchasing power from current levels for these financialized currencies. And that's just a matter for markets. Markets will make up their own mind. They will suddenly turn around at some stage and say, well, this is the reality of the situation. I have got a lot of dollars. And incidentally, foreigners own $33 trillion of securities, short-term securities and cash deposits in dollars, 33 trillion. And when you bear in mind that's roughly 1.4 times US GDP, you can see everybody's got dollars. So at some stage, they're going to come out of the dollar big time. What do they go into? Another collapsing currency? No, they will probably go into commodities. And you'll find that most of the money will get lost as the bubble implodes. But what comes out, we'll find that it's sort of, there's not a lot of commodities to buy at anything like current prices. You will find that prices will suddenly start rising. And it's that point, I think, that you will find that I just wish I had some physical gold. And incidentally, talking about financialization, if we can call it this process definancialization, the idea that you can protect yourself by buying futures or forwards or whatever, forget it. That goes in the anti finance bubble as well, the whole lot. So no, I'm not saying this is 100% certain, but I'm saying is that what I see is getting more certain by the moment, and that is the thing that worries me.
Right. A little closer to home for you. It seems extraordinary that Extinction Rebellion is going about whatever business it goes about, frivolous and decadent to do that sort of thing in a time like this. Do you think there's going to be an impulse where the West reverts back to understanding that the UK's got these enormous shale reserves that can be extracted very cleanly, reduce its energy independence on foreign parties? Likewise, the United States is sitting on enormous mineral deposits that are known but are being blocked for environmental and, the general ESG reasons. Do you think we can get religion and start mining in mass again in the West?
I think the answer to that is yes, Tim. I think it's a sort of series of events. The first thing is the destruction of our system, then we suddenly think, oh my God, you know, at that stage, you can't afford to start protesting about things which really at the end of the day don't matter too much. You know, whether you're woke or not is completely irrelevant to the fact that suddenly we're in survival mode. So I think the answer is yes. When we are in survival mode, then you will find that people will, you know, and the political class will then have the mandate, but they need the mandate because they're basically weak people. They need the mandate to go out and do these things. But it's only after we get the crisis that they will have that mandate. And incidentally, I think that the way in which currencies will eventually be secured is that at some stage, they will drop all this sort of funny money, Keynesian stuff, get realistic, and realize that, you know, as a central banker, if I'm going to get, you know, if I'm going to get paid at the end of the day, I don't want just rubbish paper. I mean, we've got to stop this sliding in the currency, and they will reintroduce some sort of gold standard. Now, I'm not hopeful that they'll get it right first time round, but I think that that is what happens. And a very good precedent for this. I mean, if you saw what happened in Hong Kong at the end of the Second World War, the Japanese military yen was worthless, absolutely worthless. But what John Cowperthwaite and the Hong Kong cadets who took over the situation did was they arranged an exchange rate with these worthless bits of paper with the new Hong Kong dollar, just to get the Hong Kong dollar into circulation. And I think that's basically what happens every time. So the currencies will be turned into gold substitutes. Let me put it that way. But I mean, we're looking at getting closer to the Venezuelan situation than the situation today before that happens.
Well, pessimistic note and optimistic note at the same time. A lot of people get hurt in that situation, and hopefully it doesn't go too far down the track. Alasdair, we've used up our available time. Thank you so much. You add so much value to all of this, and I encourage everyone to read your newsletter. Your Twitter feed is actually fantastic as well. I must compliment you on your ability to manage the new technology. Thank you for your time, and we look forward to talking again. Bye-bye.
Thank you very much indeed for having me, Tim. It was my pleasure.